Hi guys, in today's video we're going to have a short recap of the stuff that we've discussed last lesson. So I'm going to recap what is cash flow forecast, what we need to include in a cash flow forecast, and then we're going to cover some main or most common cash flow problems that can occur in a business. So net cash flow, we know that we calculate that as cash inflow minus cash outflow. So remember, we say that at any given moment, a business is measuring the cash that it has in hand or the cash that it has on it. And based on how much cash is inflowing to the business and how much cash is outflowing from the business, the cash in hand either increases or decreases. The cash in hand can never be a negative number. So if we are making a cash flow forecast, so we are somehow predicting what our cash inflows and cash outflows will be in the future. If we see that at the end of the month, we might have sort of negative cash on us, then it is a good tool. The forecast is a good tool for us to somehow find other sources of finance. For example, take an overdraft or take a bank loan in order for us to be prepared and actually have that cash on us. Remember, the cash inflows don't always come only from sales revenue. So this is just one of the sources when we sell products to our customers, but we can also have other cash inflows from non-revenue sources. For example, we can, as I mentioned, take out a bank loan for a certain period of time that will give us a huge sum of cash that we can use. We can receive a grant, or we can, for example, sell some assets that we are not currently using. They're unused. They're not necessarily necessary for the daily running of the business. So how or what are the different sections in a cash flow forecast? We have 3 sections. Net monthly cash flow, we already know what that is. Opening cash balance and closing cash balance. This is showing us how much cash are we holding at the beginning of the month, at the start, and the closing cash balance is showing us how much cash is held at the end of the month. So these are the 3 sort of groups, or if you want to split it up into this big chunk into more parts, then it would be 5 sections or 5 things that we need to include: cash inflows, cash outflows, net monthly cash flow, opening balance, and closing balance. Now, this was the example that we showed in the lesson. What I suggest or would like you to do, make this a habit of yours when you're constructing cash flow forecasts. Make sure that you actually include headings. Make sure that you actually include the sort of total sums or totals in the middle of the cash flow forecast, to have some kind of let's say milestone from which you can move forward. So here, as you can see, we have all the cash inflows listed. So owner's capital injection, cash sales, payments by debtors, and then you have the sum. Then you again have all the outflows listed. So we are paying for some lease, we're paying for some rent, for materials, labor, other costs. And then again, we have a sum of that. Yeah. So if you want to get high points, to score a lot of points on cash flow forecasts, make sure to have this, to have them organized, to have them neatly drawn up, to have it structured, because that way you're not going to get lost in the numbers. It is always easy to add up these three numbers, five numbers, to have the sort of totals of the cash outflows and cash inflows, and only then use those sums to calculate the net cash flow. Yeah, much easier than if you would try to do it all at once. So this is the first part that the cash flow forecast contains. So cash inflows minus cash outflows equal net monthly cash flow. And then the second part sort of is the opening balance, net cash flow, and closing balance. So the relationship between those would be, or the formula that we would use is actually we take the opening balance, then we add the net cash flow. In this case, the net cash flow is a negative number because it's in brackets. And we get, as a result, the closing balance, also a negative number. So if we have a cash flow forecast like this one, we know that we can suggest to the business owner or business manager that they should take an overdraft, or they should find some other source of finance to cover this lack of cash in the business in the month of January. Also, don't forget that the closing balance of 1 month is automatically going to be the opening balance of the next month. All right, so this is just a recap. If you haven't, if it's too fast, then please go over this chapter in your book. There is going to be much more explained and in more detail. Now I would like to mention the causes of cash flow problems. So why do businesses, let's say, face some cash flow problems? What causes those problems? There are different, obviously, sources or reasons for these problems that are mentioned in the book, in the syllabus. Obviously, you can come up maybe with some more problems. So let's just have a look at the ones that we need to cover. So for first one, very typical, is over trading. That happens when a business expands too quickly without the sufficient resources. What does that mean? For example, when a business buys too much of stock, too much inventory, it basically uses most of its, let's say, cash. Most of its working capital goes into the inventories, but then doesn't have sufficient or like big enough customer base. The customers are not buying the goods fast enough, and so we are not able to keep on trading. Yeah, we have sort of burned the business. So instead of let's say buying large sums of inventories or large amounts, it might be better to start small, test the business, test if it's working. Yes, we might not be able to achieve bulk buying economies of scale. However, we need to start the business small and then expand in an organic way so that the business can stand the quick expansion, especially the cash, so that it's sufficient. Second reason or problem that we can face is over borrowing. So what does over borrowing mean? It's actually the fact that the more capital is raised through external sources of finance, the higher the cash flow on loan interest payments. Yeah, if I over borrow, I use external sources of finance too much, then then the interest payments that I have to pay every month loan might be higher than my cash inflows. And that way, I'm not going to be able to pay my monthly payments on the loan. Maybe if I gave one of my assets as collateral to the bank, then they might take some of those assets, and basically that can cause insolvency for the business. So don't over borrow. Borrow uh, only rather smaller amounts. So, and also depending on how big the payments every month are going to be, to make sure that you can cover those. Overstocking, that's when you buy too much stock. Stocks cost money to buy, they cost money to produce and to store, and this money could be spent elsewhere. So actually you might be asking, okay, what is the difference between overstocking and overtrading? Overstocking, yes, it's buying too much stocks, and the stocks have some extra cost to them. Overtrading can also happen, for example, when it doesn't necessarily need to be related only to having too much stock, but for example, let's say you pay for an advertisement that is going to bring too many customers to your business, more customers than you are able to provide the product to. And instead of, let's say, being able to manage them at that time and satisfying their needs and wants, you either provide a poor service or you sell them a poor good. Therefore, the customers become angry, dissatisfied. They might leave you for their competition, and you're never gonna get them back. Or it can just mean that you won't be able to serve them at all. So you'll have to say, sorry, we don't have the capacities. We have, we don't have any stock left, and they'll leave either way. So that can be another example of overtrading. Overstocking is happening when you buy too much stocks. Then the fourth example is poor credit control. So when we were talking about credit, we can talk about the credit that we give to customers. So for example, some businesses don't offer credit, but if you start offering credit, that might mean that more customers are going to be able to afford your product. Maybe that will somehow give them an incentive to buy your product. But then at the same time, that extends your working capital cycle. Not every business can afford that, because that will mean that your working capital will need to be higher. On the other hand, you can also get the credit from your suppliers. And the idea of credit control, you need to somehow manage the two credits, the one that you give and the one that you get. It doesn't make sense for you to offer credit, to offer better credit, let's say, options than what you're getting from your suppliers, because then basically you will be the one paying for the credit. If you choose your customers or debtors wrong, then some of those debtors will not be able to pay you back. So basically, choice of debtors is also super important, unless if you want to get paid, you basically need to choose those debtors that are going to be able to pay you back. And the last one could be some unforeseen changes. So these could be changes coming from the external environment. You can have changes in demand, which would, for example, be caused by some seasonal changes. or your machinery breaks down and suddenly you cannot produce products, so you have to buy a new machine, that sort of thing. So, any of these unforeseen changes, uh, the business should also account for and ideally have some reserves to make sure that you can um, have or afford these unexpected cash outflows coming from out of the business. Okay, so this is about the cash flow problems. Now, short exercise: taxi firm's cash flow. How would the following events be likely to affect the cash flow of a taxi operating company? So, how would an increase in oil prices, for example, affect the cash flow of a taxi operating company? So, when we're talking about cash flow, think of this tank. An increase in oil prices, would that be a cash inflow or a cash outflow? What do you think? So, if oil prices increase, obviously, as a taxi operating company, I have to pay for my gas, for my petrol. And if my variable costs increase, then my cash outflows will increase. So that will affect my cash flow negatively. I'll have less cash in my business. So the second one, an increase in unemployment. How do you think that will affect the net cash flow? So we can have a look at this, or this will affect the business maybe in two ways. On one hand, if we have more unemployed people, then maybe people are going to be less likely to buy taxi services. So we will have less customers. Why? Because if people are unemployed, they'll have lower disposable incomes, and uh, they won't be able to afford our services. On the other hand, unemployment can also mean that maybe more people will be looking for jobs. And if we have some taxi drivers um, already working for us, but new taxi drivers are going to be asking for a job at our company, that basically increases the supply of labor and means that we don't need to, let's say, raise the salaries of our taxi drivers as much. Because if one of our taxi driver is going to ask for a raise, well, we can always say, oh, but I mean, I am not going to give you a raise. There are so many people who want to work for the wage that you have. If you're not satisfied with your wage, then leave. I'm going to employ somebody else. So you can always, unemployment in a way is going to mean more competition for your current workers. So I'm not saying that this is going to decrease the salaries. That is unlikely. But it might at least stop or freeze the cash outflow for a certain period of time. Now, the last one, lower train fares. How do you think that is going to affect net cash flow? So the trains are a competitor in a way to our business. If people are going to go by train, take a train instead of a taxi, then more likely they're going to be affecting us negatively when it comes to our cash inflow. Basically, we're going to lose customers and our cash inflow is going to decrease. Sorry. On the other hand, one of my groups, one of my students have argued that lower train fares can also mean that people are going to use cars less. And therefore, for example, if they're commuting larger distances, they're going to use trains. And then for short distances, once they're inside the city, that can actually increase the demand for taxis. So it really much depends. I mean, here we don't really know if the taxi is operating mainly inside the city, and whether the train fares, whether the trains are working for people between cities or also within the city. What are the, let's say, usage patterns? But we can also argue that lower train fares in a way can increase cash inflow. So this is pretty much it for the cash flow topic. It's good now to do some exercises, and next lesson we're going to have a look at some strategies for dealing with cash flow problems, which would be reducing cash outflows, improving cash inflows, and having or sourcing additional finance. So what those are going to be, we're going to have a look at next lesson, so that you can figure it out yourself. But otherwise, this is going to be the end of the unit, because we have already discussed the difference between profit and cash flow, the working capital cycle, how the size of the working capital cycle affects the working capital needed. We have talked about cash flow forecasts. We can construct them. Hopefully we can analyze and apply them as well, make some calculations. We have maybe talked about the relationship between investment, profit, and cash flow. If we haven't, we're going to cover that as well in the lesson. And then also we're going to evaluate the different strategies for actually dealing with the cash flow problems mentioned in today's video. Thanks for listening and have a nice day. Bye.